clear, we are short actually the holding companies for the bond insurers, and I found Joe's remarks very interesting about the failures of some Japanese institutions because the owners kept taking dividends out even though, as the regulators were putting in capital to save the subsidiaries. We're short the holding companies which survive by virtue of dividends they take out of the insurance subsidiaries, and actually our interests are in fact aligned with those of the policyholders. We think the insurance subsidiary should retain as much capital as possible, and that capital we should use to pay claims, and the holding company should not be allowed to take out money to benefit management and their shareholders. I thought I'd first start, before I got to my specific remarks, on the Buffett announcement this morning. I think the brief things I've read in the media so far I don't think accurately characterize what Buffett has offered and the significance of what he's offered, and I think it is a potential very significant mitigant to some of the systemic risk issues associated with the failure of the bond insurers. So let me describe what those systemic risk concerns are. I think the biggest concern is that of the $2.4 trillion of debt that's guaranteed by bond insurers, 1.6 trillion, 1.5, 1.6 trillion are municipal bonds. The municipal bonds are held by individuals. Municipal bonds are held by money market mutual funds. They're held by various kinds of rules-based regulated institutions, the kind that Jim's spoken about. And just to give one example, the SEC for money market mutual funds has a rule called Rule 2A7, which provides that a money market mutual fund can only hold or have no more than, has to keep 95% of its capital in securities rated basically AA- or higher. What this means is that if a bond insurer is downgraded from AAA to single A, and the underlying ratings of those bonds is less than AA-, that these institutions will be forced to sell these securities in order to meet their SEC-mandated 95% holding of AA or better bonds. The result could be a massive selling of securities, a dumping of securities, and in light of the supply-demand imbalance, you could have big losses taken by money market mutual funds. And this does present a real risk to the market. What Buffett has offered to do for the three largest bond insurers, MBIA, AMBAC, and FIGIC, is basically reinsure all of their municipal exposures. And here's how the math and the exchange works. Basically, the way municipal bond insurance works is the municipality or the issuer pays the bond insurance fee up front. So the bond insurer gets money up front, and the bond insurer makes a promise to make good on interest and principal payments over time for the insurer. So today, on, for example, MBA's books are in their investment account are funds they've received for prepayments or 30-year